Hello. Start over. Hello, everybody. Sorry for the delay. We had technical problems with the sound. And so, of course, at the beginning of every show, we like to talk about, kind of a summary of what we saw happening with the market. And really appreciate your patience here. Just starting off on the summary, so I'll start off with this. And of course, we've been looking at this chart of the S&P 500 for a couple of years now, actually. And you can see this goes back to really 2021. We had that great run up. We hit the high at the very beginning of 2022, dropped 28%, got to October of 2022, and then we had a really nice recovery, and especially right at the end of the year, one of the really historic climbs that came out of that downturn from the end of October till really the end of the year. So this week, what we're seeing, of course, is some downturn. This is not unusual, especially in a year where you have a lot of gains. And if you look at what is selling off, it is mostly the things that have big gains from last year, right? So that makes sense. You don't want to take those gains in December, really. If you had a stock that you think you want to pare back on or what have you, take some profits, or maybe you want to sell something and buy something else that has that whatever you're selling has a profit. You normally would want to do that in January. Because it just allows you to, have the rest of the year to maybe if you have some losses, you can write off against them. You do it in December, you're going to have to pay that, maybe in April or even January 15th with your quarterly payments, depending on how you do it. So not unusual after a year like this to see this type of scenario, at least in the first week or two, some weakness as far as that goes. We're actually deploying some of our excess cash today. We had that downturn, little backup. One of the things you'll notice here, it's a little bit faint, but there's a line that goes across that shows kind of where we are today. If you look back really at the end of 2021, you can see we're right at a resistance level. We're sitting right at a spot that has some support. So not a bad place to be nibbling, in my opinion. There's a lot of things that are going on that I think are pretty good as far as that goes. And we'll talk about, some of the things that came out even today as far as that goes. But really amazing chart. It's a lot of volatility.
Yep.
I mean, if you look, there's a lot of ups and downs there. Just because, again, when you raise rates as much as we've raised rates since the really beginning of 2022, that should be down pretty substantially. It should be coming down more smoothly, kind of like what we saw in 2008. But because we have these other counter forces, the pandemic, the government put out a lot of money, and people are having more fun now, going out and doing things and spending money. The consumers out there doing pretty well, traveling and what have you too. So that really is kind of these two forces that have been battling back and forth. And really overall, the good side is one. That's kind of why we're back. We almost hit an all-time new high again at the very end of the year. We've backed off of that. I don't think backing off is a bad thing.
Yeah, it gives room to grow, is kind of take a break.
Yeah. Well, we'll talk about this in a minute too. It's kind of stretched out, so it needs to come back. But it's almost like it's on sale. I mean, we always hear this. Hey, I got it on sale. And it makes you spend money. But if you liked it at a certain price, and if it's cheaper, and some people maybe missed out on some of this run up as far as that goes. And so you get this kind of spot where it moves. And the other thing I always talk about, if you look at that downturn that happened kind of right between Easton and I, that ended in October 27th.
Yep.
Well, mutual funds have to capture their losses by the end of October. And so lots of selling happens, right? But then what happens? You now have cash. And so then money starts to come back in. And there's a whole host of factors that would cause that type of run up, with short covering and the Fed, cutting back on, their rhetoric about raising rates and all these things, and inflation doing better, et cetera. But the same thing's happening now.
Yeah.
If a lot of people are taking profits and they have cash, I saw a stat today that $57 billion this week was put into money markets. And so that's a lot. And so that's enough money to maybe get the thing going again. So that's why we're kind of nibbling here also as far as that goes. If we look at kind of this measure here, okay, I just added this purple strip in here. This is called the RSI. It's a relative strength index. It's developed by a gentleman by the name of Wilder It is very well followed.
Mhm.
Matter of fact, you can tell kind of what's going to happen based on this. I always talk about the stretch of the rubber band because that to me it just kind of makes sense. If you take a rubber band and you stretch it, you can get certain distance, but the farther you go, the more resistance you get, right? And eventually it kind of snaps back down, and because the resistance gets just so high. If you look at what happened here, that peak right above Eason's head there, that was a 82.
Yeah,
You
that's
know?
quite high.
That's very high. Matter of fact, that's the highest in this going back to 2021 here. It's the highest it's been. And so that's pretty extreme stretch. I've seen 86, way back. I've seen some higher ones, but what's going to happen there is you're bound to have some type of pullback off of that stretch. And again, now we're back down. It's hard to see these numbers, but we're back down to 55. That's quite reasonable, getting kind of into that average arena as far as that goes. So that's part of that kind of taking a rest also, is kind of get back down. It'll allow people that look at these types of things more confidence to come in with their money. One of the reasons we had some excess cash, because I hate buying when this thing is above 70.
Yeah.
Because we always have money coming in from all kinds of different sources, and we'll usually hold off when this thing gets above 70 just because it generally comes down after that. Matter of fact, Eason found a really cool chart here. A little hard to see all these numbers, but if you just look at the bottom here, the grayed out portion, the average. So if you look at when it gets above 70, right, on a 1 month basis, 1 month later, it is negative on average, negative 1.14%, and it's only positive 47% of the time. So again, if you're buying when this thing is above 70, at least in the very short term, you might be looking at some loss, for the 1 month basis. When you get out to 3 months, positive, not a lot, but positive, 6 months, 12 months. 12 months is actually very fascinating. 12.07 is higher than the average. Average is around 11.
Yeah.
A little bit less, but around 11 long term. And this again for the S&P 500, but 94.7% positive. Of all of these times where it got above, going back to 1990, right? That's pretty good. And so what that means to me is that sometimes when you get these big stretches to the upside, there's a lot of excitement,
Yeah.
right? And that excitement doesn't dissipate immediately. And it's a lot of these indicators are the breadth, the Martins-Weig breadth thrust indicator is kind of the same thing. Huge motion upward. It just, again, it's only happened 18 times since 1945. But what it shows is just this excitement that's there, and it doesn't disappear immediately. And so, even though we might have some downturns and what have you, right now I think it's some profit taking and whatnot. Altogether, that's a good thing. It brought us back down to RSI. It's around 55. That's better, and I think we can kind of keep going forward from here. Now, I wouldn't be surprised to see some of that profit taking continuing again for another week or so.
Yeah.
And there are some important points here. Let me go back just real quick. We almost got to the all-time high. All right. In technical analysis, when we look at this, what that means is so far what we have is a double top.
Which is not a good sign.
Not a good thing. Now I think we're going to break through and we'll set it up, but it is important going forward here to watch for that and make sure that we do break through. And then I'll feel much more, comfortable about that, because a double top is one of these things where, looking back historically, you can then, you could literally be in a range here, a very big range, where you're kind of going sideways and so you fall back down towards that bottom, those types of things. I think there's enough power for what's happening out there right now to keep this going and keep this moving forward. There's certainly enough money on the sidelines to kind of do so. But I wouldn't be surprised to see a little bit of weakness here again for another couple of weeks. Now, this is very fascinating. Eason also found this chart. What this shows is going back to 2014. You can see, the average rate of return for the total rate of return for the S&P 500 and how much the top 10 contributed to that. So if you look at 2023, return was 24%. That light blue, the darker blue is 17%. So it means that of that total percentage, 24% gain, 17% came from the top 10 stocks of the S&P 500, and the little green bubble up there says 75% of the return, right?
Yeah.
That's pretty high. Right?
Yeah, that's pretty unusual for a year.
It is. Now, here's something, and so here's something that I think is important. What's been talked about, this market's so narrow, it's not going to hold up, right? Because it's so narrow, it's going to fall apart and what have you. I actually disagree with that. In my experience, long term, going past the data, this chart, when things are uncertain, all right, and there's no doubt there's a lot of uncertainty here. You had most of Wall Street predicting a recession for last year. I mean, an unbelievable number. Matter of fact, I saw projections for negative 20% last year all over the place. So if you're a big money manager, you don't want to abandon all of your stocks. But you're going to move money towards some of these big stocks. Matter of fact, I don't know if you guys remember this, but their debt ceiling argument that we had, we started seeing those stocks do well.
Yep.
Because the thought process was, hey, Apple, Microsoft probably survives this debt ceiling debacle better than some. And so during times of uncertainty, they tend to buy these really big companies. And the reason that they're big is because they're well run and they usually have really good financials, and they have lots of cash flow, maybe even lots of cash on hand. I mean, hundreds of billions of cash on hand sometimes. And so what will happen, though, if the market continues to do well, is you'll see a broadening of that out. So a lot of people are pointing to it and say, oh, the market's going to fall apart because it's narrow. I'm actually saying, hey, this is the beginning of an upturn. Potentially, and it's not that unusual to have this happen in times of uncertainty. And so right at the end of the year, we started seeing small cap stocks do well.
Yeah, they're still running.
Matter of fact, we've kind of accumulated some of those ourselves here in our portfolio. And again, that's going to be the evidence of that kind of broadening, is seeing that mid cap, small cap kind of take off, the other 490 stocks in this index starting to do well. There's always something not doing well, even in great markets, and there's always something doing spectacularly well. But this is not unusual to see in a start of a run, right? So let's not, get too carried away with it's too narrow. It could be okay. It will be important to see some breadth come through. Get through to that new all-time high with some more breadth. That's what I'm looking for. And so we're waiting for that. That'll be something to watch for in 2024. The job report came out today. So this is in Bloomberg. It just shows how many jobs were created, right? Month by month since October of 2022. That was the low point for the stock market.
Yeah, it was pretty good with jobs report. It came in slightly, I think, above expectations.
Yeah, I copied the chart out of Bloomberg here, and so kind of fascinating. So expectation was 175,000. We created 216,000 jobs. I keep getting asked, why is the stock market doing so well if the economy is not doing well? And my answer is really simple. Number one is the stock market is a leading indicator. So it is predicting what's going to happen. And the reason that it came up from October of last year to now is because the economy is actually quite good. If you look at job growth, it's been fantastic. Now, jobs are not the best thing to look at because they tend to lag the actual economy, mainly because, it takes so much time to hire and get the ads out and interview people. And it also takes a lot of time to let people go.
Yeah. Right.
You got to go through the process, figure it out, So jobs can be kind of lagging, but these are actually really good numbers. And, unemployment was 3.7, estimate was 3.8. That's a good thing. And then average hourly earnings were up 0.4%. Again, if you annualize that out, that's 4.8%.
Yeah, and having a strong economy, there's some fears that Fed will keep the rates the same and not lower them. So that's one fear in the market.
Well, this is the biggest irony. So if you're worried about a recession, this is a good report because it's less likely, especially with the earnings growth and, what have you, to give some people some chance to spend money and keep a recession at bay. If you're worried about inflation, this report makes you a little bit nervous because now, hey, look at what's happening. Now, here's my counter to that. And I said this all last year on these Fridays with the big job reports. We've several times had a situation where the market has fallen because there was too many jobs created. But my thing is that this part of this, because of this pandemic, is a supply side shortage. We have a lot of demands for services. We went from spending money on goods to spending money on services once we could get out of our house and do things. And so we need more people to come in to take these jobs. There's 8.8 million jobs open. And that's way off of the high of 11.4 million that it was at, but still significantly higher. Probably the average is around 4 or 5 million. Yeah. I mean, it's really, really high. And so I see this over job growth as helping ease the supply constraints, which can maybe help inflation. And the market's up today. So I think, and market was up last time we had one of these reports that was higher than expectation also. So I think there's some realization for what's happening there as far as that goes. But the bond market is struggling today because of this too. So, that's going to be interesting to see how that plays out. But if we look long term or longer terms, this goes back to 1996. This is from, the Bureau of Labor Statistics. And here's the number of jobs, right? You can see it dips, those big gray bars, the first gray bar there's 2000, recession, jobs dip, fine. The 2008, they dip. Of course, the pandemic, which is we had a 2-month recession, in the pandemic. 15 million jobs were lost, mainly because people closed down, because we couldn't be open, restaurants, all these things. But if you look at that trend since then, we're above where we were pretty significantly before the pandemic started. And so, this is going to be one of my themes actually for the first part of this year, is just trying to point out that the economy is not doing poorly. And I'll show all kinds of different things that are happening out there in that realm. And the stock market is a leading indicator. And again, if everybody's so worried about 2024, the stock market would probably already be coming down. It's a 3 to 18 month leading scenario. Now, sometimes the market can get surprised, right? Outside events, geopolitical events, what happens with China and Taiwan, what happens in Ukraine. There's things that are happening that could, surprise the market because it's not a perfect predictor. But generally speaking, if you watch the market and it's going up, you can probably expect the economy to be doing fairly well in the future. On an average basis, you would be best betting in that direction. As far as that goes. So I don't know. I think this is a really fascinating time frame to watch what happens. Are we creating a double top? Do we get into a new high? Those types of things. These are the things that we'll be watching for right now. And so I think things are doing quite well right now. I'm optimistic about what's coming up here. But again, we don't operate our business and our investment models based on projection basis. We watch what's happening and we kind of react to those, because right now you could make projections of all varieties.
Yeah, you could say the economy's going to blow up.
Yep.
Or go, through the roof.
If you listen to Wall Street's projections last year, you missed out on a 24% stock market run, right? And so again, watch what happens, look at the primary trend, stay invested if the primary trend is still up, maybe get a little bit more conservative if the primary trend starts to deteriorate, but stay in there until it turns into the primary trend is down, right? And that's the process. I didn't make that up. That's actually something that Charles Dow came up with in the 1880s, and it still works. I think it's a good sign and something to watch for as far as that goes. So anyway, that's what's happening this week. Really appreciate everybody kind of listening, to our summary. Look forward to being able to kind of do this again next week. All right, so what's our first question that we have?
How often should one look to rebalance their overall portfolio? If there's a bull run in 2024, should I be rebalancing more often?
Okay, so it's kind of interesting. There's a lot of different ways to do rebalancing.
Yeah, you can do it on a time period. You could do it on a percentage of assets. That you can change it based on your parameters.
Yeah, for a very long time, we did something called opportunistic rebalancing, which is where we have a model. Let's say we have a 10% slice in our model, and we'll give it a 20% leeway before we'll do something. So that means it could go plus or minus 2%. So for between 8 and 12%. So if that position stayed between 8 and 12, nothing happened. But if it went down to one of those or up to one of those, then it would trigger a rebalance, and we rebalance the portfolio. That actually has probably, I think, a fantastic method for rebalancing. Right now, we don't rebalance. We'll do it when things kind of really get, messy within the portfolio, just to bring it all, tighten it back up. But we don't do it from a return standpoint. What we do is this, here's our list of ETFs that we're going to buy. We're going to watch those ETFs. We're looking for the wave as it comes up to the top. We want to buy those that are on a momentum basis. We want to hold them as long as they keep that momentum. And we'll usually have a cut line in that list that says, okay, as long as it stays above on return basis, above that line, we'll hold it. When it gets below that basis, we'll move it. So we had some move today. We've had a fair number of moves even this year
Yeah.
because we're starting to see more motion within the market as far as that goes. So we'll move out of one area and into another area because we want to keep in front of those kind of hotter areas, mainly for our target pieces of our portfolio.
Rebalancing is more if you're on a kind of like a buy and hold, and so you're kind of, I'm keeping these same positions in the same sense, but I'm just adjusting their weight to my portfolio.
Yeah, so this is traditional rebalancing. Long ago, we used to rebalance, on a calendar basis. And again, I would say this is probably still the prevalent method that's being used in our business. I don't think it's the best way to do it. This is what we morphed from doing it on a calendar basis to doing opportunistic rebalancing to doing this rotational thing. Okay, so I think the rotational piece is better, and it has proven, at least to me, that it is. But this was a great report that Ethan found from BlackRock, just showing kind of rebalancing, and it's changed a little bit. Pre-pandemic, post-pandemic. So if you look, the orange is buy and hold, all right, the returns, right? And the yellow is rebalance once a year, and then the green is semi-rebalancing. And so what happens there is that you can see the green is pretty dominant in both time frames, actually. So a semi-annual rebalance would be the way to go if you were doing it based on a calendar basis. So you'd rebalance, say, now, which again could cause some of the downturns and some of the things that we're seeing right now. But then also you might rebalance again in June or end of June, right? Beginning of July, if you're doing it on a semi-annual basis. But to answer the question directly, if I'm looking at 2024 and it is a good market, it's a bull market, I'm looking at that from a standpoint of just pure rotational basis. Now, if the stock market component wildly outperforms the bond market or vice versa, eventually we'll bring that back down just because we have a risk target that we're going for.
Yep.
So if a client has agreed to a 60%, risk levels, or 60% stock risk level, I don't want that piece to grow to 80 because now they're in a model that they didn't agree to be in.
Yeah, and that's when people start to get a lot more jumpy.
Well, it's also, it doesn't fit them. That's why we agreed on 60. There's a risk of, suitability for us and just in terms of legal risk. So maybe we get to 63, 65 or something, and we'll do a rebalance just to kind of do that. We don't get that a lot because the bond market and the stock market have this interrelationship. It rarely really outperforms one or the other, so much so that we get these big imbalances. But that is a point we will rebalance. But it doesn't have anything really to do with returns. It has more to do with maintaining the risk level for that client at that level. And that would be the same for anybody who's managing their own money. You should have your own idea for what risk you're wanting to take and, understand what that means. That's really important. And then, just kind of rebalance based back to that risk level. Otherwise, let it run, do the rotations.
Yeah, I think it's not about having a set time period. Maybe it's just for your scheduling that you have a set time period.
Right.
But like if you have like some sort of parameters that you have to hit this parameters, that's really when rebalancing shines through.
Yeah, no, it's a great question, and it's really interesting. There's been a morph in the business, certainly in our business, across several things, just things that we found that work better, right, altogether as far as that goes. So, all right, so what's our next question?
How do I pick which positions to liquidate when withdrawing from a taxable or tax-deferred account? So how do I pick what to, like, when I'm taking a partial withdrawal, what should I pick to sell off?
Yeah, let's say you have a $200,000 IRA and you want to take out $20,000 for whatever reason. What do you sell? You got these positions, and what should you sell? One thought process might be, hey, I've got this one part that's not doing very well, and I'm going to sell that. I wouldn't do that normally. Normally, I'd just replace that position. I'd use this rotational concept that we use and say, okay, if it wasn't doing well, we probably would have already been out of it, especially if it's in an IRA, because we don't have to worry about the taxes. And we're moving on to the next thing that has the better wave. So to me, the model is dominant. Okay, so I got an example, just a generic example here of kind of what I'm talking about. This is a 50% equity model. We have 10 of them, 10, 20, 30, 40, all the way up to 100%. the blue side would be the stock, the green side would be the bond. You can see we got these big core pieces, right? And then these targets. So it's 3 targets on the stock, 2 on the bonds. And so I am working those core pieces. I have a list of core holdings. They're all competing to be on that list, right, and get in that model. I use a sports analogy. I played soccer, who's on the bench? That's everybody else on the list. Who's on the field? Those are the people that are in there, the ETFs or what have you that we use. And so there's different size universes. The core universe is much smaller because I'm only going to buy, very broad pieces. The target is much larger universe, actually, a lot more ETFs that we have to choose from that are more targeted, but tend to be a bit more volatile. So we restrict those, right? But so I don't want to mess with that. That's what's creating our return. We're trying to beat the market after our fees. I don't want to mess with that and say, oh, I'm going to sell that one target. Well, what if I sell one of those targets? Now I'm underweight stock, right? If I sell that 4% target that's right over my shoulder there. And so the way that we do it, we put it into our software. We say, hey, we want the 20,000 out. It takes a look at that model and it brings it back into line. You usually have something that's over that model. It might be the bond parts, it might be, the stock parts or whatever. And it just, boom, brings it back to this 50-50 model and takes that 20,000 out by essentially taking some of the bigger pieces that have, accelerated faster than
it's selling off any kind of piece that's kind of overperformed in a sense. Right. And so the idea is, since you're not putting this money back into the market, you want to kind of sell at a high point.
Yeah, exactly. And so that's how I would do it. It's, we have a software that does it for us. We don't have to do the calculations, but the calculations aren't that difficult. In my opinion, if you're going to manage your own money, you should have exactly this. Here's my targets, and here's what I'm doing. And I want to, if one of those targets is at 6% or what have you for the stock side, maybe I sell 2% there. And I gather my 20,000 by bringing my portfolio back into line as much as possible. If it's already in line, I might sell a piece of all of them. In today's world, you don't have the transaction costs like we used to. It used to be $29 to sell a mutual fund. And so if you did that, you just want to sell as least number as you can. Yep. Now we don't have that issue. You can be much more refined in how you're doing withdrawals. So anyway, I think that's the way that I would do it on a recommendation basis. It's how we do it here. Uh-oh. Oh, there we go. There we go. Oh, sorry. All right, so next question.
What is self-insurance?
Well, that's pretty broad, right? Because there's a lot of different types of insurance.
Yeah.
But I guess the broad answer would be that you have enough money to cover whatever might happen.
So whatever risk you're trying to insure for, you have the funds to cover that risk.
Yeah. So theoretically, you could, say, okay, if I got in an auto accident, I have enough money to cover whatever might come up. Or if I ended up in long-term care, my spouse ends up in long-term care, I have enough money to cover that long-term care. What's kind of interesting is insurance is there's an analytical aspect of it, certainly. And we cover that all the time in our different plans in different ways. We look at, whether somebody's self-insured for health, for long-term care, for life insurance, those types of things that you can actually put into a plan and analyze. But like anything else, there's an emotional component. I've seen this come through pretty prevalently with insurance, especially. I remember one time I was meeting with somebody and he's like, yeah, for me, I have enough money to pay for the insurance and it just makes me feel good.
Yeah. Peace of mind.
Peace of mind. Personally, on my own aspect, I do the same thing. I've never hardly, one time we had a flood in our house. We ended up having to claim, for the hardwood floor repair. I think that's the only claim I've made in the last, God, I can't even remember, 30, maybe ever, actually. And so I paid a lot of money for insurance that I haven't used. But again, I really like it. It makes me feel good. It makes me feel like, okay, I'm not going to, have a big outflow, pay these little bits and pieces every month. It's a bit of a nuisance, but anyway, so self-insurance is about kind of getting to a spot where you don't pay for insurance for particular areas because you have enough assets. But I have some very wealthy clients that still want the insurance because they really like the peace of mind.
Yeah.
Yeah.
So one of the most important things about a financial advisor is having you be able to sleep at night without worry.
Yes, and insurance does that to a certain degree. I just think personally, it's like, okay, I would spend money to go to Hawaii because I like Hawaii. I feel relaxed there. It gives me, some time off, and I feel good about it. And so I'll spend money on insurance because it makes me feel good, right?
Mhm.
So again, I know that's not, what you probably want to hear from an analytical financial planner, but that's what I'm running into when I'm talking to clients all the time. So, but that's the concept. We can calculate that and figure that out. We get questions about it all the time. Should I have long-term care or not? Let's see if you need it, first of all, and then if you really still want it because it makes you feel good, let's figure out how to do that. Or life insurance, I have this life insurance policy. Should I keep it or not? And again, it kind of depends. And you don't discount the emotional aspect of what you're trying to do there because it's important. All right, what's the next question?
What is a closed-end fund, and are they worth looking at?
Okay, so closed-end fund is a mutual fund, okay, that actually, do they do closed-end ETFs now? So the difference between mutual fund and ETF is, generally speaking, that's kind of blended now too, but generally speaking, it means that there's an active manager or not. But now there's a lot of active management ETFs too, so it's kind of funny. So the biggest difference is how they trade, right? So a closed-end mutual fund trades once a day.
Closed-end mutual fund actually trades like a stock.
So it's because it's on the secondary market. Yeah.
Yeah,
So
it's
that's
not fixed. Yeah.
and that's what an ETF does. It trades like a stock. You can trade it, by the minute, so to speak, or what have you. So what happens is that a normal mutual fund is, let's say it has this big basket of stocks. They're worth X amount of dollars, and we have so many shares, and basically they just divide the value of the shares into the number of shares into the value of those stocks, and that's your share price.
Yeah, and so whenever new money comes in, they just buy more shares.
Yep.
While a closed-end fund, the idea is that no more shares are issued. So kind of like a stock. You have your IPO, that's your fixed amount of shares, and that's kind of what's in the market.
Yeah, so the share balance isn't changing. It's changing in an open fund. It's not changing on a regular basis anyway, or on a closed-end fund. And so what happens then is that the net asset value can sometimes get disconnected from what is happening on the actual value of the share, because the actual shares are exchanging on the secondary market. So you can have a net asset value that's actually worth more than the shares. That's what's called trading at a discount. And so there's a lot of arbitrage that happens around that, where they'll try to keep that pretty much the same. They don't get too far off. But I have seen periods of time, 2008 comes to mind, where there's some disconnects that happen, and the value of the actual assets, let's just say it's $10 a share, and it's worth $8.50 is what they're asking for right now. It's and so if it eventually recovers back up, you can make more money just because of that recovery, along with whatever happens to the actual value of the basket of stocks, right? So yeah, we don't use closed-end funds that generally have some higher expenses and different things. They have some liquidity problems, right?
Yeah, because they're on the secondary market, they're just less liquid than a regular mutual fund or ETF.
Yeah, and in a time of stress like 2008, I bet you liquidity gets worse. And it's probably why they're trading at more of a discount, because people are kind of desperate to get out. Now, good investors are generally stepping in when everybody else is running out. So that would be a time I would look at a closed-end fund as far as that goes.
Because you're getting a discount, it kind of magnifies that return on the net asset value. If there's
that one I just $10 versus you buy it for $8.50. If it just got back to $10, you made $15%, more than that actually. But you made your $1.50 a share. But the $10 basket could now be worth 11, right? So again, you might be moving up. It magnifies that potential rate of return. So we don't deal with them. They're a little out of the comfort zone. We generally deal with really basic things.
It's harder to deal at an institutional level on that, because we're buying at such large quantities. Is there enough share out there? Are we changing the market? That's a lot of reasons why.
Sort of like, we can't get involved in these really small stocks, and we don't do a lot of individual stocks, because we're going to buy $50 million worth of some stock that only trades 500,000 a day. that's a problem.
Yeah.
So that's why we generally stay away from some of these things too. So good. What's the next question?
Money market funds are paying higher interest rate than my bank account. Is it a good idea to keep a majority of my emergency fund in my brokerage account in the money market funds?
In the money market funds. Within the brokerage accounts, there are different types of money market funds. What's usually attached to your brokerage account does not pay that much, mainly because it's a transactional piece where there's, money can come in and out so fast. And that's also where the brokerage firms make money. So they tend to have a fee coming out of that money market. But you can go out. I know, like, for example, at Schwab, which is where our money's held now, you can go and buy one of their Schwab money market funds. It's literally a mutual fund.
Yeah.
You got a ticker symbol. They don't have a transaction cost. They have some of them that pay really, really well, especially if you put more than $1 million in them and those types of things, right? So they have different levels. Generally speaking, you're going to give up FDIC insurance to get those higher returns. They do have FDIC insured money markets, even at the banks themselves, but they tend to be less return. But one of the things we're seeing right now that's kind of interesting is there's a pretty big bifurcation between these big banks
And the high yields.
and the yields that you could get in a lot of other places. That's different than it used to be because these big banks have become the too big to fail. People are willing to go to the Bank of Americas and Wells Fargo's, and even though they're going to get less on everything, CDs, money markets, savings, checking, they're willing to take that risk because they're not afraid of having what happened to Silicon Valley Bank or First Republic Bank happen to them. And they just want that peace of mind and knowing that, hey, I've got this huge bank behind me. So to answer the question, yes, I think that there is some validity to using these money markets in all varieties as part of your savings accounts for emergency. No issue, no problem with that. And it says majority. I'm okay with that too. But I would take a look at other alternatives also, because I do think if you look, the Federal Reserve says rates are going to come down 0.75% on their last dot plot by the end of this year. We have the market. If you look at the futures market, saying roughly about 1.5% going to come down this year, and that'll be a big argument. We'll see where things end up. But if rates are going to come down, the money market will come down immediately. There's no holding that rate up. So if I got 5 at the beginning, I could be down to 3.5 if the market's right, or whatever. And so maybe some of the money should be in some CDs that are a little bit longer term. 1, 2, 3 year CDs, even a ladder, a 1 and a 2 and a 3 year CD for part of your emergency money. Because even though you've got a situation where a CD isn't as available, if it's an emergency, you can get it out. And there's all kinds of different CDs, different places you can get them and what have you. I don't want to get too convoluted with that. But just from a standpoint of trying to maximize rate of return within that emergency money, that would be something to take a look at. Now, in the end, what I look at, and I'm trying to maximize the money in my stocks and bonds. And my real estate, right? Those are the things I really want to maximize. You're kind of, putting a very small bit of icing on a nice piece of cake when you're trying to make more money on your emergency. Because to me, the emergency money is for safety. Period.
Is it worth your time to do this arbitrage?
Right.
Is it worth the extra effort to deposit the money, invest the mutual fund? Because when you think about it, if you have only a 1 or 2%, difference, it has to be a really big amount to make it worthwhile at that time.
Yep. Yeah. To me, emergency accounts, the payoff isn't the return. It is the comfort and peace of mind. And it makes you a better investor. If you have enough money to make you, when you go to sleep at night and the market's falling apart and you think, okay, I have this chunk of money in very safe place, and maybe it's not making a lot, but when I go to bed at night, I say, wow, that's enough money for me to last for quite a while, whatever that is. For some people, it's 3 months. For some people, it's 5 years. Everybody's got a different thing. And there is no rule of thumb. It's you. What do you think, and what makes you comfortable? If you have more than that, you shouldn't be trying to maximize return at the banks or money market. You should put it in the stock, bond, or real estate market, in my opinion. But your core asset for emergency funds is, in my opinion, for your peace of mind. The payoff is knowing that it is in a safe place. So when everything else falls apart, I'm not just talking about little fall apart. I'm talking about 2008 Great Depression type falling apart. I mean, you want to know that this thing's going to be there. And so, a true money market to me, they sell for $1 a share.
Yep.
Right. They've had some that have become 94 cents a share. 2008, we saw some 94, 95, 96 cents a share. And because they had pieces inside there, they were high yielding ones that had commercial paper that defaulted. And emergency fund should be for emergency. I wouldn't worry about the return as much as I would worry about where it's at and just knowing
How quickly I can get
yeah.
to it.
So treasuries or FDIC insured, those types of things to me are more important. And exactly what's the liquidity, right? How fast can I get to it? So that's just a sidebar for kind of what the question was asking, but I think it's actually maybe more important to understand, from a psychology standpoint. This is what I deal with all the time, talking to clients, and I've been doing this for this will be my 38th year. And going through this and talking to people, really understanding, this is what makes them feel comfortable. Because when things fall apart and I'm meeting with them, I want them to know, hey, they have this. Not everybody needs it as much. That's my thought process on emergency funds. All right. That's the end of our show today. Thank you for putting up with our little technical difficulty there at the beginning. But we got through it and look forward to being able to see you again next week. Again, send in questions. We love answering your questions. Give us, some time here during the week to answer them. You can use the email here, asktom@talkmoneywithtom.com, and we can find some charts, or we love charts, and what have you. And then secondly, of course, subscribe to the channel and start to increase your education. Even if you have an advisor, the more that you know, the more you'll be able to understand and communicate with that advisor, the more comfortable you'll be with, say, the stock market, the more that you'll probably make in the stock market. I think that's a really important component. It's really why we started this whole channel in the first place. And of course, you can meet with Ethan and I. You go to the book appointment button on our website. There's a link here on the channel. You go up on top there, hit that yellow button. Our calendar is online. You can find a half-hour time to meet with Ethan and I, and we'll discuss your individual questions one-on-one. So thank you so much for coming today. I really appreciate it, and look forward to seeing you again next week.